Well, hello and good afternoon. Welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us today as we explore the concept of partnership accounting in the spring 2023 semester here at UDC. Happy to have you here, as always. First and foremost, I want to thank all of you for your hard work in the course so far. Happy to report that you all are passing at the moment. That is a wonderful thing. So it makes me proud. My goal is to make sure that you all do well, right? That's why we hold these sessions every week, and that is why I try my absolute best to remind you to try to get that work done on time. If for whatever reason you are a little behind, please know that it is very important for you to get that work done. Okay, very, very important. So the last assignment, which was for chapter 11, were short essay questions. I believe there are 5 questions in total. I have not yet graded those. It takes some time. It's a manual process, as you know, for grading and feedback, especially on those essay questions. So I typically read those very carefully and then I grade them accordingly, right? So if you haven't done those yet, please make sure to get those done as soon as you can. That will certainly help me and it'll help you, of course, to stay on top. And if you ever need help, you just let me know and I'll be happy to help you. So that's where we are in the course. So again, thank you all so much for your hard work so far. I do appreciate it. The great news is you're all passing so far. And if for whatever reason you've fallen a little bit behind, please make sure to get those remaining items in as soon as you can. I appreciate that. So let's go ahead and talk about this concept called partnership accounting. I'm sorry. Just before we do that, in the classroom, for those of you following along at home, we are in Module 3. And we made it all the way to week 12. So we're at the end of Module 3. Wow. Oh my goodness gracious. The end of Module 3, if you can believe it already. We got about 3 weeks left in this course. The course ends on April 29th, is the last day of the semester. We got 4 chapters to go through still. During the last week, we will cover 2 chapters, but I promise you they are short in nature. Just kind of show you the structure here with chapter 12, partnership accounting. PowerPoint presentation, the exercises, I started to break those out to help them make it a little easier for you to find those. Those exercises, they're just there to help you practice, right? Exercises, they're not graded. They're just there to help you practice. Okay? So feel free to try those questions out. They're Excel documents. You could download those, play with those, experiment a little bit. They're just really there to help you practice, understand the concept of what we're talking about today. And then, of course, for this week, due on Sunday night, you have a quiz for Chapter 12, 2 attempts, as always. Please feel free to take your time. If for whatever reason you don't understand one of the questions, just reach out to me. A quick email will be sufficient, and I'll be happy to quickly respond to you. So, just wanted to show you the format for week 12, and that's where we are today. So again, thank you for your time. Let's go ahead and jump into our discussion on partnership accounting. The whole idea behind partnership accounting is to help you to understand how accounting works when it comes to a partnership business. A partnership business is where 2 or more individuals own and operate the business. Where 2 or more individuals own and operate the business. That is considered a partnership business. Partnership businesses can take many forms. of a business. It could be a simple partnership, LLC, limited liability corporation. It could be an actual corporation. It could be S Corp, C Corp, or some other structure of business. And we'll talk about these things. And throughout this discussion, I'll show you how to do a couple of transactions that a normal partnership would experience, such as forming the partnership, new partners entering the business, existing partners leaving the business, any types of withdrawals from that partners might make, any contributions partners might make, and then lastly, a dissolving liquidation of the business. I'll walk you through the life cycle of the business and show you the various transactions that accompany that. So first, let's talk about businesses and their organizations. Partnership, as I mentioned, is two or more individuals that form a business together. And this could take many shapes or forms. But for the most part, partnership businesses have these elements associated with them. Formation of the business was voluntary. There's an agreement that governs the business. This partnership agreement outlines what partners are bringing into the business, such as their own cash, other assets like property, plant, and equipment, or any other contributions that they bring in. And this partnership agreement identifies the percentage of the business that each partner owns. That's the concept of a partnership agreement. It's like a governing document that helps to guide the business at the formation of the business. Most partnership businesses are limited in life. When a partner decides to retire or for other reasons departs the business, that typically ends the business as a whole. So partnerships have a limited life cycle. They only exist during the time that the partners are in the business. Partnerships have an unlimited liability. This part hurts a little bit. Okay. Unlimited liability means that if the business gets sued for whatever reason, the liability extends to the individual's private life. Meaning that if the business gets sued, that means the individuals that own the business are being sued. And when that happens, that exposes those individuals to all of their assets, their house, their car, their other personal assets, whatever it may be. So unlimited liability, it's a major part of a risk when forming a partnership business. Let's see here. Co-ownership of property. This is where the partners co-own property, plant, and equipment. So that means that they have to make decisions on buying and selling property, plant, and equipment together. Mutual agency. The partners have mutual understanding and mutual responsibility of the business. The partners share in paying taxes for the business. These are all common elements. A partnership business is formed. Let's talk about the types of partnerships. There are limited partnerships, limited liability partnerships. I like those ones. S corporations, sometimes C corporations, and limited liability companies. You'll notice that each of these types of partnership businesses have their own unique elements. In thinking about this, want to understand these differences between these four types of partnership businesses because it will help you someday if you decide to get into business with someone else. In thinking about that, you want to think about liability. How liable will you be in a partnership business? Does that mean unlimited liability, whereas the business gets sued, that means you get sued? I personally try to stay away from that kind of liability. So I might favor something like a limited liability partnership or an S corporation or an LLC. In most of these cases, you'll notice that taxation is treated the same way. The difference primarily here involves the number of partners and the liability that those partners hold. Take some time, read these four differences. There might be a question, right, about the type of corporation, or type of business, sorry. So, how do we know which is a good one to choose? I I personally like this slide here because when it comes to considering the type of partnership, this slide kind of sums it up for us. As I'd mentioned, what the biggest two differences between the type of uh, formation of the business that you select is based off of liability and the number of partners. Taxation is usually always falls on the individuals, except in a C corporation. What I mean by that is the income that is earned by the business is taxed based on the individuals that own that business. We call that a pass-through entity. Pass-through entity means that the business taxes go to the individual partners to pay. That usually gets filed with their personal taxes. So for those of you who are going through the process this month of filing your taxes, which by the way, you only got about a week and a half left. If you're going through the process of filing your taxes and you made some business income that was maybe not reported to the IRS, when you go to report that, there's a schedule called a C schedule. There's also an S schedule, or Schedule S. These schedules help business owners to file their taxes that the business made based off of the income the business made. Yeah. There's separate forms that you need to fill out along with your personal taxes. That's why you see with limited partnerships, limited liability partnerships, limited liability corporations, and S corporations, individual business does not pay the taxes. The individuals that own the business do. See? In other words, the income made by the business gets passed through onto the owners of the business, and they have to file it with their personal returns. Yep. When it comes to the liability, that's why I mentioned earlier I personally like the LLPs and the LLCs, because limited liability means that the individuals are not exposed personally. They're not held personally liable when something goes wrong with the business. It's important that when you do go into business, you protect yourself. I strongly recommend an LLC. When the business first gets started, there's a couple of accounting entries that we need to make to recognize the formation of that business. First, we look at what the individual partners are bringing into the business, both good things and maybe not so great things. Individual partners within the business typically bring in both assets and liabilities into the partnership. Here's a couple of examples. Let's say we have two partners. Let's say Damon and Henry decide to open a business together. They're thinking about how they're going to structure this business. Now, Damon, he decides that it'd be a great idea if I bring in $25,000 in cash and let's say it's a retail business. And Damon and Henry decided they found a place that they want to rent. They put the deposit down and they took out a short-term loan to revitalize, renovate the storefront. So Damon brought in $25,000 in cash. The partners together took out a small business loan for $10,000. Henry brought in $10,000 in cash plus some equipment worth, say, $15,000. So in total, Damon brought in $25,000 in assets. Henry brought in $25,000 in assets. But the partners together took out a $10,000 loan. So in all, if the partners decide to split everything equally, 50% owner, 50% owner, that means that they share in both the assets and liabilities of the partnership. See how that works? The idea here is that percentage ownership in the business is based on the assets and liabilities that each partner brings into the business. Any questions on that? Is that pretty clear?
It's clear.
It's clear. All right, great. Thank you. So we bring in each partner brings assets and liabilities into the business. These are recorded at their market value for the assets and liabilities brought in. What we mean by market value is what it's worth at the time that it was brought into the business. Of course, cash we know is cash. It's $10,000. That's $10,000. If it's a piece of machinery or equipment, we need to know what the value is of that machinery or equipment at the time it's brought into the business. If it's bought brand new and it's never been used and we're going to use it for that business, we might identify its value as the purchase price. If it's used, we look up its value. How do we do that? We look at things like a blue book. A blue book is kind of like when you buy a used vehicle. If you've ever bought a used car or used vehicle, you identify its value using what's called a blue book method. Kelley Blue Book is a company that provides the information from sources to tell us how much a vehicle is worth based off a number of mileage or hours used or whatever. In what condition. That's how we assess its market value. It's what it's worth at the time it's brought into the business. We record the assets and liabilities that the partners bring in at their market value. The third thing we do is we look at contributions that increase the partner's capital account and decrease the partner's capital account when they take money out of the business. Here's what I mean by that. When Damon and Henry went into business together, we increased their individual equity accounts. Remember, equity is what the owners own. Remember the accounting equation? Who can tell me what is the accounting equation real quick? Remember, what is the accounting equation? Three parts, remember? What is the accounting equation? Damon.
So assets equals liabilities plus equity.
Correct. And assets are what? What are assets?
Assets are what the business owns.
Correct. What the business owns. Liabilities are?
But my note says owes someone else.
Correct. What the business owes. So assets are what the business owns. Liabilities are what the business owes. And equity is what the owners own. The owners own. That's the way you're thinking about equity. It's what the owners own. Okay. I know it sounds a little funny. Assets equals liabilities plus equity. Assets, that's what the business owns. Liabilities is what the business owes. And equity is what the owners own. It's the difference. Okay? Equity is the difference between assets and liabilities. Assets equals liabilities plus equity. That accounting equation is always in balance. See, if there's a difference between assets and liabilities, that difference is equity. Another way that you can rewrite the accounting equation is assets minus liabilities equals equity. The difference, you see? So equity is the difference between assets and liabilities. Very well done. So when Damon and Henry decided to open their business, they both brought in cash, and Henry brought in some equipment, right? And so in thinking about that, when they brought those assets into the business, we debited the asset accounts to increase them, right? To show the increase in cash, the increase in equipment. And we credited what's called the capital accounts. It's an equity account. The capital accounts represent the exact value of the assets that the partners brought into the business. So in our example, we have Damon that brought in $10,000 into the business. So we debit cash, $10,000, and we credit partner Damon capital account, $10,000. That shows the representation of what Damon brought into the business. You see? Over time, partners can withdraw cash from the business. They usually do that to pay themselves, or sometimes they might run on cash and they need to use it for something personal. No problem. We call those owners' withdrawals. They're withdrawing assets, usually cash, from the business. Again, that could be to either pay themselves or it could be for some other use that's personal. So in that case, we debit the partner's capital account in the form of an owner's withdrawal. What that does is it reduces their capital account, and we credit cash to reduce the cash. So over the life of the business, partners bring in assets, and they also sometimes take assets out of the business. We need to account for those transactions. That's what that third item tells us. The fourth item tells us net income or loss is allocated to the partners according to the partnership agreement. If you think about our earlier example, Damon and Henry are 50% owners. Damon owns 50% and Henry owns 50% of the business that they started together. Damon brought $10,000 in cash. $25,000 in cash. Henry brought in $10,000 in cash and another $15,000 worth of equipment. The two partners took out a small business loan for $10,000. Okay? At the end of every single accounting period, we have this thing called net income. It's at the very bottom of our income statement. Y'all remember the income statement, right? It's our sales, and then we have all of our expenses. Sales minus cost of goods sold equals gross profit minus all of your expenses equals net income. Net income is what's left at the end, right? That's why you call it net income. Net income gets distributed to the partners based off their percentage of ownership in the business. In our example, Damon would receive 50% of the net income that the business made for that year. And Henry would also receive 50% of the income made from the business that year. Now, if it were a loss, meaning the business didn't do so well, we didn't sell what we expected that we were going to sell, and we ended up losing money instead of earning money, we call it a net loss. Partners are responsible for covering the difference. So instead of having an income, if the business lost money, the partners have to pay into the business to cover the losses according to the partnership agreement. See, it works both ways. I'm going to walk through a larger example to help you to understand the concept a little bit more. Here we have a business called Boards. This business, sure, overall is a pet boarding business, yeah? Maybe it's a horse boarding business or a pet boarding business. It's a pet hotel, we'll say. So here's how it works. We have two partners that decided to form a partnership business called Boards. One of the partners, Zane, made an initial investment into the business of $7,000 in cash and $33,000 in a building. The building. And also brought in a loan for $10,000. So, make a journal entry based on what that first partner brought into the business. To do that, we identify what they brought in, both assets and liabilities. $7,000 in cash was brought into the business, so we debit cash $7,000. That increases the cash. Jane also brought in $33,000 in a building. We debit facilities building $33,000. The partner also brought in a note payable, a loan of $10,000. So we credit note payable $10,000. That increases the liability by crediting the liability account. You see? Now take a look at the capital account for this partner. Credit the capital account $30,000. You'll notice it's $30,000. Why isn't it $39,000? Reason for that is because of that loan that the partner brought into the business. So earlier I had mentioned that the equity account is kind of like the difference, right? Assets equals liabilities plus equity is the accounting equation. Assets equals liabilities plus equity is the accounting equation. The accounting equation can be rewritten as assets minus liabilities equals equity. Having said that, the assets, $39,000, minus the liabilities of $10,000. You see, that's the concept here. So $40,000 in assets minus the $10,000 in liabilities equals the equity paid in capital for the partner Zane of $30,000. Questions on that? Makes sense.
Yes.
Thank you. The second partner, Perez, brought in $10,000 in cash. Great. That's a very easy transaction. I debit cash $10,000 and I credit paid in capital for partner Perez $10,000. Very straightforward. Let's look at some transactions as we go on. Okay. Throughout a partnership business, partners are going to make withdrawals from the business, and it's usually in the form of cash for their own personal use. Partner withdrawals are debited on the own separate withdrawals account. Partners' capital accounts are credited or debited based off of what they're doing with net income or net loss, based off of the partnership agreement at the end of the accounting period. We discussed this a little bit earlier. It's where the partners share in net income or the net loss based off of the partnership agreement. That's to say, it's based off of their percentage of ownership in the business. And the last part here is the partners' withdrawal accounts are closed out to their capital accounts at the end of each accounting period as well. They're what we call temporary accounts. And we learned about that when we talked about this concept called the closing entries. Remember that? That was a long time ago. That was probably maybe the second or third week of this course. So let's talk about these kinds of entries. Partners are not employees of the business. They're partners. That means they're owners in the business. Partners do not get paid salaries. No salaries. Partners do not get paid in salaries. They share in the profits, the net income of the business or net losses of the business. That's how they get paid, you see. Partners don't make a salary. They get paid based off of the profits or losses of the business. That's one of the big differences between owning a business or being an employee. That when you own the business, the way you get paid is based off of the profits that you generate in that business. You see? So partners share in profits or losses of the business. And it's based on that partnership agreement. The partnership agreement identifies typically a ratio. That ratio tells us the percentage of ownership that each partner has. And I'm going to show you what that looks like in our earlier example with our two partners. It could also be paid based on capital balances or services, capital, and stated ratios. One of those three options is a possibility of how the partners get paid. Again, it's typically expressed in that partnership agreement. Let's take a look at this example with our two partners. Zane, remember Zane brought in cash and a building. I think it was, what was it, $10,000 in cash plus a $33,000 building or something like that, or $7,000 in cash and a $33,000 building. Sounds right. $7,000 in cash and a $33,000 building is what Zane brought into the business. That's fantastic. That's $40,000 in assets. But remember that there was that loan for $10,000, so $30,000 was the capital account. Perez brought in $10,000 in cash into the business. If you look at it, that ratio, how it breaks out, that means that Zane technically owns 2/3 of the business. How do we figure that out? Zane brought in a net of $30,000 capital into the business. Perez brought in 10. 2/3 of 40,000. Right, of course. 30,000. Makes sense. So 2/3 of the business goes to Zane, 1/3 of the business goes to Perez. It's based off of what they brought in. If the partnership income was $60,000 for the year, this is how much each partner would receive into their capital account. So let's say your net income at the end of the year was $60,000. Zane would receive 2/3 of that. Perez would receive 1/3 of that. 60,000 times 2/3 is 40,000. What Zane would receive. Perez would receive 20,000. That's 1/3 of 60,000. Make sense? We're all doing good so far. Maybe? Are we okay?
Yes, I'm following, Professor. Thank you.
Okay, thank
Yes,
you.
Professor.
Awesome. I appreciate you all. I do. Sometimes this teaching online stuff isn't that easy. Okay. So, let's take a look at the balances. The income was $60,000 for the year. Zane started the business with $30,000 in the capital account. How did we get there? $7,000 in cash, $33,000 in a building. That's $40,000 in assets brought in. Zane also brought in a $10,000 loan, so that means that the balance of equity was $30,000. Assets minus liabilities equals equity. That's how the accounting equation can be rewritten. Since Zane owns 2/3 of the business, this is based off of the ratio, which is typically based off of how much they bring into the business at the time the business was formed. 2/3 is expressed as 75%. The income is $60,000. 75% times 60,000 is 45,000. Perez brought $10,000 into the business, which is 1/3 of the business, or 25% based off a ratio. The income was $60,000. That means Perez received $15,000 of that profit. Okay. So at the end of the year, those allocation they get added to their balances. Well, this is the journal entry that we make to allocate the income to their balances. Debit income summary, and we credit the individual capital accounts based off of the amounts, of course. Okay. Based off of their partnership agreement, there are a couple of conditions that they included. Remember, the partnership agreement is a governing document that helps to guide the business. It provides an understanding between the partners of how much each partner brought in, how much of the business each partner owns, and any other stipulations that the partners agree to. In this business, this example, the partners had some stipulations. Some of the partners wanted a salary allowance. Okay, that's fine. You can have a salary allowance. You want a salary? Great. Put that into the partnership agreement. It's a governing document. We have to abide by the partnership agreement. So here are some of the stipulations. Zane is to receive a $36,000 annual salary allowance based off the partnership agreement. Perez will receive a $24,000 salary allowance. Cool. So you know, the reason why we call it a salary allowance instead of a salary is because, number one, partners cannot be employees of the business. It doesn't work that way. Partners are owners of the business. They cannot be employees. Therefore, they don't get paid salaries. They can, however, receive what's called a salary allowance. It works the same way as a withdrawal. Number two, each partner is allowed an annual interest allowance of 10% on their beginning capital balance. What this means is the partners agree to an interest rate where they receive an additional 10% based off of their beginning capital balance, based off what they brought into the business. It's kind of nice. The third stipulation was any remaining balance of income or loss is allocated equally. In other words, after they receive their salary allowances and their 10% based off of their beginning balances, if there's anything left in the net income, it's distributed to each partner equally. Okay, that's cool. These are all in the partnership agreement, so we have to agree to it. So let's take a look at the example again, and we'll help to identify how this works. So, let's say the net income was $70,000 a year. Great. So, out of that $70,000, the first thing we do is distribute their salary allowances. Not salaries, salary allowances. According to the partnership agreement, $36,000 went to Zane, $24,000 goes to Perez. So 70 minus 36 minus 24 is $10,000. That's what's left. The next thing I need to do is distribute their interest based on their beginning balances. In other words, what they brought into the business, I add 10% to that as their interest. Zane brought $30,000 of assets into the business. That's $3,000 in interest that I have to pay to Zane. Perez brought Perez brought $10,000 into the business. 10%, I got to give Perez $1,000. $10,000 was my balance before interest. Minus 3, minus 1, I'm down to 6. Down to 6,000. The last stipulation in that partnership agreement was to distribute the income or loss equally. In this case, I got $6,000. I got two partners. 6,000 divided by 2 equals $3,000 each. See how that works? Interesting. Now, let's assume instead of having that nice $70,000 net income, let's say it only came in at $50,000. Based off of their stipulations, that's going to be a problem, right? I would say so. $50,000 was the net income. We still got to pay them their stipulated salaries. $36,000, $24,000. I'm already over. My remaining balance is a negative $10,000. I still have to pay them the interest that they came in with. Their assets. $3,000 to Zane, $1,000 to Perez. Oh, $14,000 over. Not good. Remember that last stipulation in the partnership agreement. It said that the partners have to share equally in the net income or loss. Because of these stipulations, and because the net income did not come as high as they expected it to, there's a net loss of $14,000 after all the stipulations came out, the salaries, the interest. So minus $14,000, split that evenly between the two partners. So minus $7,000 to Zane, minus $7,000 to Perez, which, as you can see, has an impact on their income negatively. You see? Funny how that works. Got to be real careful when you sign these partnership agreements. Because I tell you, at times it could be a little interesting. In the year of 2019, Zane withdrew $20,000 in cash from the partnership. Owner's withdrawals. That's fine. Perez withdrew $12,000 in owner's withdrawals. The net income for the year was only $70,000. So here's how that works. Their beginning balance is 30 and 10. The salaries, 36 and 24. The interest, 3 and 1. The net income remaining at that time was 6,000 if it's 70,000 in net income. So 3 and 3. Giving them the total incomes of 42 and 28 respectively, for a total of 70. Then the owners decided to take money out. They took 20, Perez took 12. Gives us a total balance of negative 32. Okay, well, you know the rules. You can have negative. So ending capital balance, 52.26 with a total of 78. What do we do after these withdrawals? What it means is that the partners have less in their capital accounts. Now let's say we got a new person who's interested in joining the existing business. It happens from time to time. So we got a third person who wants to join this business. When that happens, we have to dissolve the existing partnership agreement. Problem. The partnership is created. Dissolve the existing partnership agreement and create a new one immediately when that third person joins that business. So now we got 3 partners. New partner acquires partnership interest in the business. There are 2 ways that this can happen. For one is that third person can purchase interest in the business from the existing partners. In other words, I could go to Zane and say, hey, Zane, I'd like to buy into your business with a 10% stake in the business. And the way I could do that is I can buy 5% from Perez and 5% from Zane, or I can just buy 10% from Zane, right? Depending on whatever the agreement is. It's one way I can get into their business. The second way is to invest my own assets into the partnership. Let's say, hey, I got $10,000 in cash. I'll bring that into your business. And you'll give me, or the 2 partners will give me percentage ownership in the business based off of what I brought in. Now, what that also means is that they have to come down in their percentage ownership because it still has to be 100%. It can't be more than 100%. So when there's a new partner, the new partner can purchase directly from the existing partners. The cash goes directly to those partners, not into the business. They're basically buying directly from the existing partners. So Rashid enters the business. Very cool. So Rashid decides, hey, I want to join this partnership. So we form a new partnership agreement between Zane, Perez, and now Rashid. Rashid's the new partner. Zane has 52,000 in the business already. Perez started with 26,000. Rashid wants to buy interest in the partnership directly from Perez. No problem. So the way this works is we take the capital from Perez, we're giving it to Rashid. Okay, this represents the admission of the new partner into the business. Basically transferring capital directly from Perez to Rashid. Rashid paid Perez cash in its own transaction separately from the business for ownership stake or interest in the business. See? That's one way of doing it. The other way that a new partner can join a business is that new partner can gain partnership interest by contributing assets into the business. They can bring cash into the business. Cash and property, plant and equipment, whatever. Some type of assets. These assets increase the partnership's net assets. After the admission, the assets and equity will increase. Here's what that example looks like. She decided, I don't need to buy interest from the existing partners. I can bring in cash into this business. So no problem. Rashid decided to bring $22,000 in cash into the business. Debit cash, credit Rashid. Very straightforward. The total assets went up, the cash went up, Rashid's equity went up. That's usually the way it normally works in a partnership. Most common, I should say. Bonuses are oftentimes paid to the existing partners when a new partner enters the business. Very common. And this is usually in the stipulations in that partnership agreement. The current value of the partners are diluted, they receive a bonus. Very normal. Sometimes the new partner might also receive a bonus based off of what they bring into the business. When a bonus is paid to an older partner, it typically works like this. Existing partners, Zain and Perez, agreed to accept Rashid, the new partner, into the business based off of the investment of $42,000 in cash into the partnership. Rashid received 25% ownership in the business. Any bonuses attributed to the existing partners are shared equally. That's what the stipulation says in the new partnership agreement. So, the equity based off of Zain and Perez, based off of this agreement, at the time was $78,000. Rashid brought $42,000 into the business, bringing the total partnership equity up to $120,000. Rashid's partnership percentage is 25%. That means that Rashid's equity balance is $30,000. 120 times 25% is $30,000. So what about the bonuses that get paid to those older partners based off of that agreement? Rashid has 25% ownership in the business, which means that the existing partners receive half of the equity based off of what the bonus is attributed to be. In this example, $12,000 is the bonus. Each existing partner receives half. New partner doesn't get a bonus, typically. If the new partner does get a bonus, it would work like this. Investment, you'll notice that the investment, instead of it being the $30,000 that the partner was originally brought in, it's $18,000. Total partnership equity is 96, 25% of 96, 24. Based off of this The cash is 18,000. The existing partners receive 3,000 each, and the remaining is capital is what Rashid is left with. In other words, to put it simply, is that the existing partners receive their bonus out of the new partner's capital account. That's the way I like to describe it. It's a little easier that way. As I had mentioned, partners can withdraw cash from the business for personal reasons, to pay themselves, to do whatever with. So this can happen in one of two ways. The partner can sell their partnership interest to another person, or the partnership can distribute cash or other assets to the withdrawing partner. Here's an example of withdrawal. Let's say this partner is done. Perez wants out of the business. It's like, you know what? This partnership's not for me anymore. I'm out. So we got to pay Perez out. So Perez decides to leave. The way it works is that in this example, there's no bonus associated with the agreement. So Perez receives 38,000 cash based off of the percentage of ownership in the business. Since the partner shares of income and loss equally, Perez will receive $38,000 in cash upon Perez's leaving of the business. So we debit Perez's capital account and we credit cash to pay Perez out. Let's say there's a bonus involved. That bonus goes to the existing remaining partners based off of the partnership agreement. Perez, we debit the capital account 38,000. 34,000 of that cash goes to Perez. The remaining 2,000 and 2,000 go to the two remaining partners equally. Again, based off of the partnership agreement. Sometimes the partner who is leaving might receive a bonus. Hey, it happens. That's cool too. Here's that example. Perez is leaving 38,000. Remaining distributions go to the two existing partners, and the bonus comes out of the existing partners' accounts, goes to Perez in the form of cash. That's how the bonus works. Yeah. Unfortunately, sometimes a partnership can dissolve another way, and that's in the event of a death of a partner. When that happens, the estate gets involved with respect to the partnership to control the equity. Typically, the way it works is that the estate is not going to run the business. The deceased partner and the business, the deceased partner's estate gets involved. The estate is not going to run the business. So the partnership dissolves typically. They go to settlement, record market values of assets and liabilities, and then the partners get paid out according to the partnership agreement, including the estate on behalf of the deceased partner. The business liquidates, It's because the business closed for whatever reason. There are 4 steps to close out a business. It's a partnership. Number 1 is we sell all non-cash assets. Sell the building, sell the equipment, the remaining inventory, whatever. We record the gain or the loss on that liquidation and allocate it to the partners using their income or loss agreement, partnership agreement. We pay all of the partners' liabilities first. So any liability that the business had, we pay those first. Then anything that's left over, any cash that's left over, we distribute to the partners based on their capital balances. Sometimes a partner might not have enough money to cover the difference. We call that a deficiency. Deficiency is when a partner does not have enough cash to cover any remaining loss. We call that a deficiency. The 3 partners agree to liquidate the business. There's one outstanding liability, a debt. It's an account payable for $20,000. Prior to the liquidation, this is what the balance sheet looked like. We had $178,000 in cash, $40,000 in land, accounts payable $20,000. Zane had 70, Perez had 66, and Rashid had 62. So what we do is, out of the cash, we pay the account payable, we sell the land, the remaining land plus remaining cash get distributed to the partners. So we took care of the liability, the remaining cash, got remaining land distributed to the partners. That's what the Zen ratio was. Took care of the bill, distributed the remaining balances to the partners. Now, here's what happens when there's a deficiency. This happens when one of the partners overdrew their account for whatever reason. Okay, they too many withdrawals, too many cash withdrawals from the business, resulting in a deficiency. This is when their equity account goes negative. Okay, this is the best way I can describe it. It happens from time to time. It can arise from liquidation losses, withdrawals before liquidation, recurring losses in prior periods, etc. There's a number of different reasons why this can happen. It happens. When there's a partner that has a deficiency, they must pay cash into the partnership to resolve that deficiency. Let's say the 3 partners agree to liquidate. They're going to dissolve the business. Prior to the final distribution of cash to the partners, here are the balances. Zane had $19,000, Perez had 8, and Rashid had a negative $3,000 balance. That means that Rashid is responsible for paying the partners $3,000. If Rashid is able to pay that $3,000, no problem. Debit cash $3,000, credit the capital account, gets paid out. The remaining balances get paid out to the partners. Very straightforward. If, for whatever reason, Rashid cannot pay that $3,000, for whatever reason, the remaining partners have to pay that out. It's still got to be covered. You can't just leave a balance outstanding. So the two existing partners cover Rashid's negative balance. That's the first thing they do. And then, once that's done, the remaining partners, Zane and Perez, get paid out. The partner that has a negative balance, they're not going to receive a payment. Okay? They got the company in a bad position here. So Rashid, I guarantee, did not receive any cash at the settlement when the business dissolved. Why would Rashid receive anything? They had a deficiency that they couldn't pay. Yeah, zero. That's typically the way it works. It's usually expressed out in very plain terms in the partnership agreement. Sometimes it's not very obvious, but for the most part, that's how it typically works. I can't let the class go without a ratio. Know that. Partner return on equity. This tells us the contributions, if you will, that the partners made to the business. We take the partner's net income divided by the average partner equity. To find the average partner equity, we take the beginning balance plus the end balance divided by 2. Yeah, that's how you find the average. That, my friends, is the end of our discussion on partnership accounting. Are there any questions? Anything that we covered with respect to partnership accounting? It all make sense for the most part, or what are your thoughts? Or no?
It made perfectly good sense, and I learned a lot about partnership and just business in general this chapter. So it was very
Cool.
informative.
That's great, Renell. So what are you going to do with that information now? Now that you know.
Oh, I plan to incorporate it into the business that I plan to start because it's
Awesome.
great information.
Wonderful. Now, Renell, make sure you protect yourself and do the limited liability. Make sure it's a
I
limited
noted that too
liability.
in the beginning so
Yeah,
that I'm free of any of the lawsuits or anything. I'm protecting myself.
exactly right. Well done. Okay, any other comments, questions, concerns? Like that. So cool, right? Oh, I'm so glad. That makes me happy to hear students say these kinds of things, that you learn something that you can actually apply. That's what counts, right? That's why we do these things and go through these types of conversations. Wonderful. Okay, so before I let you go, just a reminder, for this week, we have the Chapter 12 quiz. It's due by Sunday night. Strongly recommend that you take care of this one on Thursday, as we normally do. Use that time to complete your work on Thursday. At least go through it once. Again, if you run into any questions on the assignment and you don't understand it, shoot me a quick email. Be happy to respond as quickly as I can. I'm pretty quick to respond to emails. I think you all know that by now. You could also set up office hours. You can call me. We have the tutoring available, whatever you need. I try to make your life as easy as possible. I hope you see that, right? I care about you and I care about your well-being. That's very important to me. So I try to make your life as stress-free as possible. At least in this class, anyway. So again, if you ever need anything, you can always get a hold of me. I'm here for you. If for whatever reason you might be a little behind with anything, please make sure to submit your work as soon as you can. Especially that week 11 we had last week. We had the short essays. I think it was 5 questions, short essays, looking for about a couple of sentences response for each question. I'm going to be grading those over the next 2 days. It takes time, yeah? It's a process. It's a manual process. I need to read everything, grade everything, provide feedback, all that good stuff. So I appreciate your patience with that. In the meanwhile, if you need anything, you email me, call me, set up office hours. I'm here for you all the time. If there's no other comments, questions, or concerns, as always, I want you to stay safe, wash your hands, do the right things, and I will see you all again next time. Thank you so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Thank you so much.
Good night, Professor.
Good night. Good night.
Thank you. Good night.
Take care.
Professor,
Yes.
I have a question, but it's